How you doing? Welcome back. You've now finished the first module and the second module, and I'm sure in the last module on finding the house, shopping for the house, the inspection, the appraisal, you got a lot of ideas on how to check out a neighborhood, how to check out a house, how to talk to the neighbors. And now we're going to deal with the process that starts after you found the house. And you're talking about a different topic, which I affectionately like to refer to as the where's the money section. Shopping for your lender. How do you shop for a lender and a type of lender? How do you know what type of loan is best for you? How do you go through the loan process? What do you do? What are the things that can help you? That's what we're going to do in this section. So get ready. Next time you see me will be after the section 1 quiz, and then we'll have a section 2 quiz to close it out. So get ready to learn all about where's the money, how to find it, and how to get it. Now see you back here at the time of the quiz. Get ready, have fun. All right, let's start as usual by reinforcing the benefits and the reasons why we're here. We won't go into as much detail as we have on this particular slide, but you want to build equity, you want the tax savings, you want to take advantage of the longer term investment value of an appreciating asset, and thereby build in the benefits of such an asset class. So with that, we'll get started, and we're going to go to the book, and we're going to move from the book to other resources just as we have before. And let's get started. Module 3, Shopping for Your Home. As we discussed, the first part of this discussion is around the lenders. Shopping for your home and finding the right lenders. Now, first of all, there are various types of lenders that you can deal with, and we're going to describe all of them to you. First is a commercial bank, and a commercial bank is just what you expect it to be. They've got the name bank, they have all the familiar names. And so what's the difference between a commercial bank and a savings and loan or thrift institution? Most of the difference is historical, in that if you go back prior to around 1980s, banks were in the business of commercial lending, and each community had a savings and loan association that was primarily in the business of taking deposits and generating home loans to expand home ownership. After what we knew as a savings and loan crisis in the early 80s, the differentiation between some of the institutions was blurred. The banks that were doing the things that the savings and loans were doing. Savings and loans were doing things that the banks were doing. So there's not a lot of differentiation today. Just know that some institutions are heavily focused on housing. Some institutions are focused on lending to businesses. Some institutions are focused on other things. And so you want to make your way to the housing experts in each one of these institutions. Now, mortgage banks is a specific type of bank that doesn't do anything except for mortgages. And they are firms that, for all practical intents and purposes, look and sound like banks, but they don't take deposits. They raise money through investors or by selling the loans in the secondary market, that which we'll talk about later. But all of these entities can offer you a mortgage, and they have different niches that traditionally they have served, and we'll talk about that a little bit more. Credit unions is different than other lending institutions in that, unlike the others, they do not have shareholders. They do not have a profit motive. The credit union exists for the good of its membership. It exists for a a membership, and that is its core interest. It may be the teachers' credit union. In fact, credit unions began many years ago with teachers organizing an association to make it easier for them to get access to financial products. And so they serve a sphere of interest, and they are, because they have special tax advantages over the banks, they have typically not been allowed to engage in some of the commercial activities. And you'll notice now, though, some of the larger credit unions look like banks. They offer commercial loans, and in fact you'll see a lot of bank lobbying saying that if they are going to go beyond their community of interest, then they should be subject to the same taxation and regulations as banks, thereby eliminating a competitive advantage. One of the advantages that the credit union offers its members is because they don't have to pay dividends to shareholders, then all of those what would be earnings are passed back to the members in the form of lower fees, lower rates on loans, higher returns on deposits. Now, the credit union will also typically have a higher credit requirement, and we'll talk some more about the credit issues and why one would go to each of these institutions. Typically in the past, one would, if you were turned down by one type of institution, then you'd make your way to the mortgage broker, who deals with a plethora of institutions and can deal with whether your issue is credit, whether your issue is being self-employed, or some other issue that makes it more difficult to just walk in a traditional institution. And we'll talk about that a little more as we go along.